If you're buying a property in your personal name right now, there's a very good chance you're walking straight into a tax trap. And the worst part is that most landlords don't find out until it's too late. In this video, I'm going to show you exactly how the tax works. I'm going to do the actual calculation on paper so you can see the numbers yourself, and by the end you'll know exactly which structure is right for you. Whether that's personal name or a limited company, you'll know by the end of this video. Let's get into it. Here's what we're covering today. First, why buying in your personal name could be costing you thousands every single year. Second, I'll do the exact tax calculation side by side so you can see the real difference. Third, I'll answer the question everyone asks about limited companies and mortgages. And fourth, I'll tell you exactly which structure suits which investor. There are timestamps below if you want to skip ahead, but I'd recommend watching the whole thing because the part most people skip is the bit that costs them the most. Chapter 1, the problem with personal name investing. Let's start with the bad news. In the autumn budget of 2024, Rachel Reeves, our Chancellor at the time, announced an increase in tax on property, savings and dividend income. From April 2027, the income tax bands for property landlords are changing. Let me show you exactly what that means. The tax bands from April 2027. The tax-free purse allowance is £12,570. Then from £12,570 to £50,270, you would usually pay a basic rate of tax at 20%. But from April 2027, property tax will be 22%. Then from £50,270 to £125,140, you would pay a higher rate of tax, which goes from 40% to 42% for property income. And above £125,140, you pay additional rate, which goes from 45 to 47%. So everyone's tax bill on property just went up by 2 percentage points across every band. That might not sound like much, but when you run the numbers, and we're about to, you'll see just how quickly it adds up. Now, before I show you the calculation, there's something even more important you need to understand, and that something is called Section 24. What is Section 24 and why does it matter? Section 24 is a tax rule that changed the game for personal name landlords, and most beginners have never heard of it. Here's what it says. If you own property in your personal name, you can no longer deduct 100% of your mortgage interest as a tax expense. Now, why does that matter? Because it means HMRC taxes you on the gross rent, not your actual real profit. Let me show you exactly what that means with a real example. Let's say that you make £1,000 a month in rent. Your mortgage interest is £500, leaving you with a real profit of £500. Now, let's see how HMRC treats this for basic rate taxpayers first. Under Section 24, you're taxed on the full £1,000 in rent, not your £500 profit. That's 22% tax on £1,000, which is £220. But HMRC gives you a 22% tax credit on your mortgage interest, which means 220 minus 110 is £110 in tax, leaving you with a net profit after tax of £500 minus 110, which is £390. Now, here's the key point. For a basic rate taxpayer, Section 24 looks painful on paper, but the tax credit largely cancels it out. So if you're a basic rate taxpayer with a salary under £50,000 and a small number of properties with no plan to scale, then buying in your personal name might still be fine for now. But here's where it gets dangerous. In the UK, your salary is always taxed first. Then your property income sits on top. So if you get a pay rise or you buy more properties and your rental income increases, that's when Section 24 becomes a disaster because your property income can get pushed into the higher rate tax band. And let me show you how that will affect you. Same scenario, same property. You've got monthly rent of £1,000, monthly mortgage interest of £500 and a real profit of £500. Nothing's changed. But now you're a higher rate taxpayer. HMRC still taxes you on the full £1,000, which means that's 42% tax on £1,000, which is £420. HMRC still gives you the 22% credit on £500 mortgage interest, which is £110. That means your tax to pay is £420 minus £110, which is £310 in tax. leaving you with a net profit after tax of just £190. So your real profit was £500, but after tax, as a high rate taxpayer in your personal name, you're left with only £190. That's a 62% tax hit on your actual profit. Now let's look at what happens if you own the exact same property but inside a limited company. Chapter 3, the limited company advantage. This is where things change completely because Section 24 does not apply to limited companies, which means inside a limited company, you can deduct 100% of your mortgage interest as an allowable expense. Let me show you what this means if you're buying inside a limited company. Everything stays the same. Monthly rent £1,000, mortgage interest £500, but because we can now deduct the full £500 of mortgage interest, HMRC now recognises our actual profit of £500. Inside a limited company, you'll pay corporation tax of 19% of up to profits of £50,000, which means your tax to pay is £95, leaving you with a net profit after tax of £405, which is more than double the amount in your personal name. Same property, same rent, same mortgage, but the structure changes everything. As a high rate taxpayer in your personal name, you're keeping £190, whereas inside a limited company, you're keeping £405, which is more than double. And that's the difference that compounds every single month across every property that you own. Now, if you're watching this and you want to build your own property portfolio with more advanced tax strategies such as group companies and FIC structures, then make sure you're scanning this QR code on your screen now, as that's exactly what we teach inside the James Property University. Chapter 4. But what about the profit inside the limited company? I know what you're thinking. James, the profit belongs to the company, so what's the point? Good question, and it's one I get all the time. Yes, the profit sits inside the company, and to get that in your personal account, you'd normally need to pay a dividend tax of 8.75% as a basic rate taxpayer. But like with property tax, this is also increased by 2 percentage points, which is now 10.75%. But here's the bit most people don't know. When you lend money into your company, let's say you loan it £50,000 as a deposit for a property, that money goes into what's called your director's loan account, or your DLA. And you can pull that money back out at any time, tax-free, no dividend tax, no income tax, nothing, because you're simply repaying yourself a loan. So the strategy is this: you don't extract profit as a dividend, you just recall your director's loan over time, you're deferring tax, not avoiding it, it's completely legal, and it's one of the most powerful tools available to property investors in the UK right now. Chapter 5, the question I get asked all the time about mortgages. Here's the one I get in the comments every single time I talk about limited companies. Are mortgage rates higher inside a limited company? The honest answer is they used to be. A few years ago, limited company mortgage products were more expensive and there were far fewer of them. But that's changed. Since Section 24 was fully implemented in 2021, more than 70% of all buy-to-let purchases in the UK have been made through a limited company. That's a massive shift, and the lenders have responded to it. The gap in rates between personal name and limited company mortgages has almost completely closed. You will still find some variation depending on the lender and the product, which is exactly why you need to use a whole of market broker who can access every lender, not just the ones on the high street. If you want to explore your finance options, whether that's a buy-to-let, HO mortgage, or limited company mortgages, or bridging loan finance, then make sure you contact our team at James Property Mortgages by scanning the QR code on your screen now. Chapter 6, making tax digital. Before we get to the decision on what structure is right for you, there's one more thing I need to flag. It's called Making Tax Digital, and it's already here from April 2026. If you earn £50,000 or more per year from rental income and self-employment combined, and that's revenue, not profit, then you must now register for Making Tax Digital. That means quarterly tax filings to HMRC, more admin, more compliance, more accountant costs. And the threshold drops every year. In April 2026, it's £50,000. In April 2027, it's £30,000. And in April 2028, it's £20,000. So even if you're not at the threshold yet, there's a good chance that you will be soon. And again, a limited company bypasses Making Tax Digital entirely. Chapter 7, Which structure is right for you? If we're looking at personal name and when it works when you're a basic rate taxpayer. You plan on only buying 1 or 2 properties, you want simplicity and fewer admin costs, and you are coming up to retirement and your personal income is dropping to 0, which means you can use your full personal allowance. The other option is limited company. Now this works if you're already a higher rate taxpayer, you plan to scale beyond 2 or 3 properties, you want tax efficiency and the ability to defer, not just pay, you're thinking about more advanced structures in the future like holding companies or family investment companies, then the decision is actually quite straightforward once you know the numbers. If you're serious about building a portfolio, limited company is the structure for you, and the sooner you set it up correctly, the better, because transferring properties from your personal name into a company is expensive and complicated. So make sure you get the structure right at the start. If you want help putting this into action, whether that's setting up correctly or finding the right deal, then that's exactly what our fast track service is for, our complete end-to-end service, and you can apply now by scanning the QR code on your screen. If this video helped, leave it with a like. If you like the channel, subscribe, and if you've got any questions, leave them in the comments below, and I'll see you all in the next video.